We've been speaking with top economists to better understand what this economic climate means for companies' bottom lines. Today, I'm speaking with CEO and Chief Strategist for QI Research, Danielle DiMartino Booth. Hi, Danielle. Thanks so much for taking the time to speak with me again this year.
Thank you for having me. Great to be with you again.
How can companies protect their bottom lines in this time of political and economic uncertainty?
So, the idea of battening down the hatches before the hurricane comes aground. This is a time for the CEO to be working 20 hours a day and the CFO to be working 18 hours a day. In times of protecting your margins because you don't have the pricing power that you need, people speak of stagflation very often, but we forget that if you look back at your economic history from 1975 to 1979, we actually had growing aggregate levels of employment in the United States. So U.S. households were able to shoulder the higher expense of gasoline, higher prices at the pump, so to speak. Companies don't have that luxury today. They don't have the pricing power that they would have if employment levels were rising and aggregate income therefore was rising with it. And that means that cost cutting is the modus operandi. You're trying to raise productivity as much as you possibly can and get as much out of every single worker as you can so that you can weather the economic storm and live to come out of it on the other side. The more efficiently companies are being run today, the greater the prognosis for their survival.
No matter what the number is, it does seem like there will be tariffs. How much does that impact the U.S. economy?
Well, so let's take one of the largest employers on planet Earth, Walmart, as one example. So by the time they cover the operating expenses and the cost of goods sold and what it costs them to put product on the shelves and pay all of their employees, their profit margin is 2.8, 2.9%. So if you put it in the context of the profit that companies make, and in some cases, very, very low profit margins, that 10% can be very meaningful to them. And in fact, you've seen Walmart come out and say, we're not going to be able to absorb all of the costs of higher tariffs. We are going to have to pass along some of these to our customers. But at the same time, we're in a period of very high bankruptcy filings. We've seen layoffs persist as companies cut costs. And indeed, Walmart recently decided to make a major layoff. So there is at the margin this idea that tariffs can help with the trade deficit. But again, in the same sense that companies have to deal with their own internal tensions, sellers a lot of times we run into what we call the substitution effect. And companies will end up looking for other suppliers in order, to stay in business is the bottom line. If American companies don't feel that they can continue to use those suppliers, then they will switch to other countries. But as we've seen, even with the very beginnings of this trade war 2.0, there are a lot of workarounds. I think the bigger picture of trying to correct the trade deficit is a much taller order, and I think it has to be implemented and thought out very carefully and allow for, as Treasury Secretary Scott Bessent has suggested in the past, if you're going to try and incentivize American companies to buy from American producers, then you have to understand we need certainty in order for companies to plan producing in the United States. And you've got to give them a few years to put that plant and equipment in place. And hopefully there are American workers who want to produce what we've been buying from cheaper producing countries at the same wage levels. It's a very tricky proposition, and it takes a lot of time. These are not headline-shaking revolutions. You're not going to get any of these big shifts overnight. This is going to be something that takes a matter of years and not months.
Should everyday Americans care about the national debt, and how does it impact their personal, employment situation and also the value of their dollars?
So, my answer for years has been yes, and yet we've tacked on $15 trillion of debt since the pandemic hit, nearly doubling. It's just incredible to see the growth. And, it has to do with back to the Roman ages, they did take on so much debt that eventually they lost that reserve currency standing. And I think that is the very existential risk facing the United States today. It probably is not something that we need to worry about in the very short term. Moody's just came out, in fact, with a new report that says that the rate of growth of our deficit spending is simply untenable. It must slow down. Now we're spending more than $1 trillion a year just servicing the United States debt, just paying interest on that debt. But the more you're paying interest on the debt, the higher your actual debt level, the less flexibility Congress has. I hope for my children and my grandchildren's sake one day that cooler heads prevail and that we figure out how to put our fiscal house in order, because it's never ended well for countries that assumed that they would have reserve currency status indefinitely.
So what does the bond market tell us about the state of the economy?
We have seen a good bit of volatility in the bond market since the presidential election. We've seen yields go way up in anticipation potentially of faster growth. That's one of the reasons that bond yields will rise, because in such an environment, the central bank does not have to keep interest rates at really low levels to encourage companies to grow their businesses. Companies are going to grow their businesses because they expect the economy to accelerate. And we've also seen interest rates come down by the same token and the price of bonds go up, because that's a safer asset, as we have seen bankruptcies piling up, layoff announcements going through. So in these times, we tend to see bond yields falling. And then there's this other third reason, and that is this idea of debt and deficits. So if the powers that be inside the Beltway in Washington, D.C. can't seem to find fiscal discipline, then sometimes you'll see the buyers of bonds at Treasury auctions begin to demand a higher yield in order to take the risk of a country that is not operating as a company would. Typically, you do not want to see them fall quickly, because that means that the economy tends to be headed straight into a recession.
Well, that brings up another question. Is the U.S. heading for a recession?
Well, it's interesting you asked that question. The Bureau of Labor Statistics, Super Bowl Friday for dismal scientists like me, they occur once a month on non-farm payroll Friday. And that tends to be the biggest data point, the one that moves financial markets to the greatest degree. But once you begin to learn and understand how payroll figures are produced, you come to know that they're mostly modeled. Once a quarter, they have to report their actual head count to the U.S. Census Bureau. And the Census Bureau, in turn, provides that information to the Bureau of Labor Statistics. And what we found out is it looks like net job losses occurred beginning in the second quarter of 2024. And it goes to show the fallacy of using models to impute the data compared to what's actually happening on the ground. The way economic data operate is the U.S. economy tends to fall into recession prior to the unemployment rate rising, prior to job losses commencing. So it looks like the U.S. economy may well have entered recession in the first 3 months at some point of 2024. It just takes a very long time to determine this because revisions are highly lagged.
Whether people are experiencing inflation or not, you can feel it in your day-to-day decisions as opposed to whatever the national data is coming out.
And that's exactly what we're seeing.
What, if anything, can the Federal Reserve do? What is their role?
So one of the very valid criticisms of the Federal Reserve, where I worked for nearly a decade, is that they're driving through the rearview mirror, is that they're looking at very lagged data that really is backward looking, as opposed to trying to pay closer attention to some of the especially rich real-time economic data that we have in hand. Right now, unfortunately, it feels like the Fed is pretty much what we call behind the curve. So they should be lowering interest rates, and yet because they're driving using the rearview mirror, they're late to the game. This is yet another signpost for Jay Powell to say, why is the Bank of Canada lowering interest rates? Why is the European Central Bank lowering interest? Is the United States an island? Has it ever been? No. And so it's very much a red flag that we are not more in sync with other countries, especially when what we call the soft survey data are signaling to the Fed that they're really not listening to what's happening on the ground. The University of Michigan has data back to 1968. It tends to be the case when 50% or more Americans are queried and they say, in the next 12 months, I see the unemployment rate rising. So once we cross that 50% line, historically speaking, again, back to 1968, we're already in recession. Now, the University of Michigan's question has been answered in the affirmative by 64%, 65, 66% of individuals in the last few months saying, I expect the unemployment rate to be rising in the next 12 months. It's time to listen to what people are saying because we're deeply in recessionary territory when it comes to people's perceptions on the ground.
I'd be remiss not to ask about how AI will impact the future of manufacturing in the US in this context.
In the post-pandemic environment, what we've been seeing emerge in terms of demand for labor in the United States is, it looks like a barbell. Things that a computer cannot replace. Tasks such as being a home health aide or being somebody who cuts your hair. These types of minimal educational attainment positions that cannot be displaced, replaced by AI are very much still in high demand. And then equally in high demand are those with the greatest degree of educational attainment because they're the ones who can train the computers. Where should you encourage your high school children to focus what they want to major in? And one of the answers that came out that I found to be profound was liberal arts. And it had to do with the fact that it's not just the computer science, because that can be replaced by AI. It's the ability to be imaginative in your thinking such that your knowledge base is super wide and you can hence be part of the training of the computer because you have that creative bent. And I think it's great that we're seeing a wider acceptance and a renaissance of trade. Companies are now recruiting kids out of shop in high school before they even consider going to college because they're in such high demand. You get your high school diploma and on day one, you're making $70,000 a year. These are the stories we want to hear. And for younger workers out there, I'm telling them, take any job you can get because one day your future employer, and you don't know who that might be, is going to look back and say, during the toughest of economic times, this person, they were doing what they could to work during rough times. And that means that their work ethic is going to stand on its own when they have a better position. So do what you can, take the hardest classes, take the accounting classes that you do not want to take, study what you don't want to study and get whatever work you possibly can and lean on your relatives and lean on your relatives' networks in order to meet as many people as you can and widen your the spectrum of opportunities that you will therefore have in your future.
Especially since what we were talking about is we don't know what the economy is going to look like in 10 years. We don't know what jobs are going to be out there, especially with that barbell.
Exactly. So you have to do what you can and make yourself versatile.